Okay, now let's talk about the conflicts of interest between commercial bank and investment bank. Now, usually, what we have is that the licenses are separate, and that is the way it should be. An investment bank should not be doing the business of commercial banking, and a commercial bank should not be doing the business of an investment bank. But this is not true for many countries. And what we have are large commercial banks, and in your local country, this might be the situation that the biggest commercial banks, which are your high street banks, which are doing retail and wholesale banking, are also the ones which are doing investment banking, and they have investment banking divisions. Now, why is that a problem? Uh, First of all, why does it happen? So, not every economy is like the US economy, where you are having such a big economy that you can afford to have full fledged investment banks like JP Morgan, Morgan Stanley, Goldman Sachs, which are different from commercial banks like Bank of America. In smaller countries, what you usually have is big commercial banks who have investment banking divisions. Now, why that becomes a problem is that investment banks actually have access to very material non-public information. That is something we have already discussed earlier, right? And if the commercial banks other divisions like their treasury, for example, that trades in stocks and bonds, uses this non-public material information, then insider trading will be there, right? Because the investment banking division has access to this material information which is not public, and the commercial bank treasury might be using it to make money for them using this insider information, then that will be a problem. It is illegal and it is a very big offense. Also, let's say so you're coming up with a company's share which is worth $10. Now they know that it is worth $10, and if it is being issued in the market for 5, then obviously they will buy it. However, let's say it is not being issued in the market for 5, you're actually issuing it in the market you're trying to sell it in the market for 12 when you know it's worth 10. And not only are you bringing it into the market for 12, you're forcing your commercial banking division, or the money which is the depositor's money. Now, what is the business of commercial banks? It is taking deposits, and if you try to use those deposits to buy these shares which your investment banking division is pushing, then that is also something which is unfair for the clients of the commercial bank, or rather, I should say, the depositors of the commercial bank, right? So, this is two possible conflicts that can be there. How to solve this issue? So let's say you have a big commercial bank which has an investment banking division, and you are in this situation. So how do you prevent such a situation from getting out of hand? So what you have to do is you have to implement Chinese walls. Now what that means is that there should be a prevention of transfer of information from one division to another, right? So number one, to take care of the first conflict of interest, where we were talking about the commercial bank uh, forcing the treasury of the investment bank forcing the treasury of the commercial bank to buy their shares. So that should not be allowed. You should place them on a restricted list. If your investment bank is doing any kind of advisory work for a company, that company's securities should be on a restricted list for the commercial bank. Number one. Number two, to take care of the second point, which was insider trading and using material non-public information, there should be a prevention of transfer of information from one division to the other. And how you can do it? Of course, physical separation of office spaces, even using separate servers to store information. But then again, I would like to emphasize that the restricted list is very important, because well, it's hard to kind of contain information, right? Even if you have physically separate offices and separate servers, I mean, people can still talk at lunchtime or outside the office. So what's important is that if your investment banking division is working with some companies for mergers or advise any kind of advisory work or origination work, the the commercial banking team or whatever the other investment team that you have within that investment bank should not be allowed to trade in those securities. They should be put on a restricted list. Now we are going to talk about the originate to distribute model. Extremely interesting, very, very important. So what would happen is that, let's say there is a bank, and this bank has made some loans, right? And these are mortgages, house loans, and they've already given them the money, and these people have all bought their houses, and now they are supposed to pay them in lots of small payments over 10, 20, 30 years. Now the bank doesn't want to wait 10, 20, 30 years, right? They want the cash now so they can go on and make new loans. So what they would do is they would take this whole portfolio, they would take this whole pool of mortgages. After originating them, they would transfer them to a new company which would uh, issue securities like mortgage backed securities, and they would sell these mortgage backed securities. The special company which is formed for this purpose, which is called a special purpose vehicle, and it would get cash from the investors, and they would give that cash not to the pool but directly back to the bank. So the bank basically originates these mortgages, then distributes them through a special purpose vehicle to other investors. So here what you will have is your investors who are going to invest in the mortgage backed securities, and they will give the money to the SPV, which will give the money to the bank, and now the bank is done. So the advantage for the bank is that instead of keeping the loans on their balance sheet till maturity, they sell the loans to other investors, which generates liquidity for them. And they don't have to wait for 30 years or whatever is the duration of these mortgages, right? And they can immediately originate new mortgages. This is known as the originate to distribute model, and it is also done through the process of securitization. So this is done through the process of securitization. So what is happening over here is taking this pool and converting them into securities, which is mortgage backed securities. This process is called securitization, right? Now, who helps them do this or has been helping them do this? Government backed securities, government backed agencies, Ginnie Mae, Freddie Mac, Fannie Mae, Ginnie Mae, Fannie Mae, and Freddie Mac. Now, why does the government do this? See, you have to understand the government's perspective as well, that the government wants people to be able to buy their own homes, right? But the government has two conditions usually in this kind of a scenario. Number one, they want only people who are working, right? Who are making an effort to make a decent living in life. And number two, the homes they are buying are in suburban areas. So the government wants, number one, people who are hardworking people to be able to buy their own homes, and the government wants them to actually buy them in suburban areas so that the cities don't get overcrowded. So government has these agencies called Ginnie Mae, Fannie Mae, and Freddie Mac, and what they do is they purchase the loans from the banks, right? And then they issue the mortgage-backed securities, and therefore the banks are able to go on and then make new loans. So this is the whole process. But as I told you, it's very important that the banks only give loans to those people who are hardworking, making money, and are able to repay those loans. Because if the loans are bad, then since these securities are backed by the cash flow of those loans, of the underlying mortgages, if those loans go bad and the cash flow stops coming, then these securities will go kaput. And if they go kaput, then of course it's going to be a big problem for the world. And that is what happened in the 2008 financial crisis. Because the banks were doing the originate to distribute model, they knew that they didn't have to keep these loans on their balance sheet. They would originate them and distribute them and free up their capital to originate more loans. So, since they knew that they were just going to originate and distribute, then they were not that concerned with the quality of those loans, since they didn't have to bother with the repayment and the recovery and everything. They just would originate and securitize and distribute. So that led to a lower lending standard, and the quality of the mortgages that were being originated declined. And later on, what happened was that Lehman Brothers, which was one of the investment banks investing in these securities, which again is, of course, not advisable, because the business of investment banking is mostly origination and advisory, but then they are using their own capital to trade. And what were they trading in? They were trading in mortgage backed securities, which actually had a completely uh, subprime pool of mortgages inside. Subprime means the borrowers were not having that good earning ability, so they didn't have the repayment ability. So then what happened was that those securities were not very good in value. And what Lehman Brothers was doing even worse was that they were using short term financing to invest in these long term risky securities. So when the risky securities started going down, their short term financing was not being renewed, and they went into a liquidity crisis, and that is what started the 2008 financial crisis. But you'll learn more about that or if you've already gone through book one, you probably know all about that already, right? So this is covered in book one of your FRM part one. So this is obviously a disadvantage of the originate to distribute model, that since the bank is not keeping those mortgages on their balance sheet, and they're having an intention to just distribute them, then they kind of could be going for lower lending standards. By the way, this obviously isn't the case anymore after the 2008 financial crisis. Now, the latest regulation on this ensures that the bank keeps a certain percentage on their balance sheet, so that they don't so that they are conscious of the loans that they are originating. So that is it for this reading on banks. Let's go through the summary together. So what is the first thing we talked about? What are the three major risks? And here I told you that they are not three, and since the 2008 financial crisis, and this is something you must have already studied in book one, is that after what we saw, what happened to Lehman Brothers, it was not a market, well, it was a market risk, because the MBS securities were going down. So that was there, of course. And there was credit risk involved as well, in the sense that the mortgage backed securities were backed by the pool of mortgages which were exposed to credit risk from the subprime mortgage borrowers. So yes, the market risk was there and the credit risk was there, but what really created or started the problem for them was the liquidity risk, that because they were borrowing in very, very short term, and they were investing in these long term securities, and they were unable to roll over their borrowing, and that is where the whole problem started, and therefore they had to sell the securities, which then triggered this market risk, which then triggered this credit risk. So liquidity risk, of course, is very, very important. And when we think of banks, we should think of these four major risks. Operational risk, of course, we talked about internal and external hacking, and all the cyber risk is external, and internal fraud or just fat fingers, which is not intentional errors but just by mistake. So these type of errors can be there in operational risk. We talked about the difference between regulatory capital and economic capital. Regulatory capital is the minimum that is required. Economic capital can be more than that if you want a higher credit rating. So, sorry, just once, yeah. So, if you want a higher credit rating, you will go for a higher capital than the regulatory one, and that is your economic capital, which most good banks actually do. They don't just go for the minimum regulatory capital. They have their own internal models, which is producing, which is coming up with an amount of capital required, which is usually higher than the economic, which is higher than the regulatory capital, and that is called their economic capital. And this good behavior actually leads them to have higher credit rating, right? But at the very least, they must maintain sufficient capital to cover the risks that they are taking. And we just talked about the risks: credit risk, market risk, and operational risk and liquidity risk. How much that should be, you will learn in book 4 how to calculate all the capital amounts. And this is the regulatory capital, which is the minimum amount that they have to hold. Plus, on top of that, they can use their own models and come up with a higher number, which is the economic capital. And why they would want to do that is to get a higher credit rating. The purpose of this is to set funds aside, whether it is regulatory or economic. The point is to set funds aside to absorb unexpected losses, and obviously that depends on the amount of potential losses that can be, which you will learn in book 4. That how do we go about coming up with these minimum regulatory or the economic capital? What are the models we use? And very, very interesting things which the Basel 3 has actually now further improved. So yeah, so the Basel Committee regulations. There's this place in Switzerland where all the big banks meet, and this is a global thing. So it's not for any particular country. This is a global thing, and they come up with the standards that how we have to protect against any kind of unexpected losses, so that uh, it doesn't lead to a contagion risk, because big banks owe each other money and we don't want one going down, otherwise the other one will face a significant problem and then they might go down and then the whole system might crash. So on a minimum, what you need to have is 72.5% of the amount that is calculated through the standardized model. And again, I mean, before the 2008 financial crisis, what the situation was that banks were allowed to have their internal models, right? Banks are still allowed to have their internal models, but that is over and above the standardized models that are required now. So now what you have as a minimum is these standardized models, which will calculate a certain capital requirement, and you have to maintain 72.5% of that. I believe this is coming into effect from 2027. So it's not in effect right now, but from 2027. So this video I'm making at the end of 2022. So you have, as from a bank's perspective, we still have another 5 years before this comes into force. But of course, you can have more capital than that if your internal model is giving you something which is more. So maximum of these two, whichever is more. So if your internal is more, well and good. But if it's not, then at least you need to maintain 72.5% of the standardized model calculation to cover all these risks, which is your market risk and operational risk and your credit risk, of course. Initially, of course, there were only Basel only had regulations for credit risk, which was the first Basel, and then you have your amendment where they came up with market risk, and then Basel 2 where there's operational risk, and then now we have Basel 3 where they've also included liquidity risk. Okay, we talked about this as well, that how deposit insurance gives rise to moral hazard. So if your deposits were not insured, as a depositor, you would be very conscious of the type of loans your bank is making, how risky they are, and if they're making very risky loans, you wouldn't feel safe, that your money is not safe in that bank. But since you have the government backing this up, right, and you know $250,000 of your deposit is insured, up to $250,000 is insured. So what you would do is you would leave that money in the bank because you know it's insured, and then the bank could give riskier loans as well, which would then be an example of a moral hazard. That just this kind of risk management actually leads to riskier behavior. It's kind of counterproductive. But then we also talked about a solution for this, that what you could do is you could charge those banks higher premiums for this insurance, so that it discourages them to give higher risk loans. Then we talked about the business of investment banking and how they could go for either a private placement for a new origination or a public offering. And within public offering, we talked about the difference between best effort versus firm commitment. And we also talked about the Dutch auction methodology for price discovery. So private placement, obviously you're selling to a small number of sophisticated institutional investors. In the public offering, it is sold to the general public. It could be on a best effort basis where the bank doesn't take responsibility of anything. It's just that they will do their best and take a certain percentage of the money raised. So no guarantees here. However, with a firm commitment, there is a guarantee that the securities will be sold upon a certain price. In our example, that was $10 per share for 100 million shares. And if that happens, well and good. If not, then the bank will be in a loss. And if the bank is able to sell to the public at a higher price, then the bank is going to make a huge profit. We also talked about the Dutch auction mechanism for price discovery for an IPO price, where you start with a high price, which is greater than any bidder is willing to offer, and then you gradually bring the price down until the entire issue is sold. And the last price, the lowest price that is set where the entire issue is sold, that is what everybody will pay, even those that started bidding at a higher price. Then we talked about the conflicts of interest that are there between commercial banking and investment banking divisions. And one of them was that your investment banking might pressurize your commercial banking to purchase certain securities which they are pushing, or vice versa, the commercial bank might use the material non-public information that the investment bank has to do insider trading. And these can be mitigated, these conflicts can be mitigated by, so I wouldn't say prevent, mitigate. What would really help prevent them is not only Chinese walls, but as we discussed, also having the restricted list for those securities. But Chinese walls, as far as this LOS is concerned, Chinese walls help prevent these conflicts, which are internal controls that prevent transfer of information from one division to another. And here we talked about having physical separation of offices and separate servers to keep your information. We also talked about the distinction between the banking book and the trading book of this is the first video. This is the first video of this chapter. In the first video, we talked about that whenever a bank invests in security, what happens is that by default it is classified on its banking book, which means that bank is expected to hold that security, that bond, till maturity. So whatever fluctuations are happening in the market price of that security are not taken into account with respect to how much capital the bank is maintaining for that. So therefore, since you are not taking your market fluctuations into account for banking book, because you're assuming they will be held to maturity, so you will have to have a higher capital that you need to keep for this. And this is the default situation. If you do have a trading book and you are saying that, hey, I'm putting these, classifying these securities in my trading book, then you can have a lower capital that you need to keep for them, but you need to then take the market fluctuations into account and keep updating your books accordingly. That if the value of that security is going down, then you have to book that loss on your books, and your capital will go down anyways. So either way, of course, your capital is going to take a hit if what you're investing in is going down. Then we talked about the originate to distribute model, and here we talked about its benefits and drawbacks. Of course, the benefits are there, that you are able to get your liquidity generated, so you can take these loans, you can originate these loans, and instead of keeping them on your balance sheet till maturity, you can sell them and then get the cash and then originate new loans. So this is definitely very good, because the benefit is that it allows the bank to free up their capital and originate more loans. But the disadvantage is that since the bank is already knowing that we are going to give these securities to somebody else, we don't have to keep them, we don't have to keep these loans on our book, then it can induce a lower lending standard, and which can decline the quality of the loans being, or the mortgages being originated. But as I told you, after the 2008 financial crisis, we actually cannot do this anymore, and the bank has to keep a certain percentage of the loans they have originated on their books. So they are now more cognizant, more conscious of the quality of loans that they are generating.